Hi students, welcome to week 10 of Business 222, Accounting Principles. This week we're going to look at the form of a legal entity called corporations. We've talked about these before in earlier chapters, but we're going to do a little bit deeper dive right now. Look at some of the components that make up a stockholder or make up a corporation, like stockholders' equity. And what is stockholders' equity? What does that look like? We're going to look at the issuance of stock for cash and other assets. So we're going to dig into a little bit about some stock items. And I do have some extra items to read and whatnot in the module itself underneath the materials for success. So you should be looking at that too. Some short articles and things about stock and PE ratios. Then we'll also look at one of those ratios, looking at some of the important ratios in the chapter. I'm going to cover just one of them. It'll be the PE ratio, but make sure you read the entire chapter. A lot of good stuff in there about corporations and keeping track of it. And of course, the quiz will cover all of that stuff. So make sure you read the whole chapter. So a corporation is a separate entity like we've talked about before. And where does their capital come from? What's contributed capital is what it's called, through stockholder investment. And of course, other people can put capital in, but they usually do it through the purchase of stock. So whenever you form a corporation, you have these what's called articles of incorporation. Usually they're filed with the state, for example, that you incorporate in. And picking the state to incorporate is a pretty important decision because of some of the tax laws that are different in different states. So, and I forget which states are pretty popular right now, but there are certainly some unpopular states. New York is, for example, one of those states. A lot of people don't like to incorporate there because of the tax structure. Some of the advantages of incorporating is it's a separate legal entity, so there's limited liability for people who work at the company or people who have stockholders. So creditors can kind of like satisfy their claims, if you will, only against the assets of the corporation. It doesn't get to the personal assets of the corporation's owners. It's pretty easy to generate capital, and it's easy to transfer ownership through selling your stock. And this idea of continuous existence. Yeah, and corporations don't last forever, but they tend to last a lot longer. Some of the disadvantages. There's this idea of double taxation. So a corporate earnings are subject to federal and state income tax, just like a separate legal entity. But if any of the corporation's earnings are paid out as dividends, then there's also taxes on that too. It may restrict the ability of a small corporation to borrow money. So while it is easy to borrow money, if you're a smaller company, it could be harder if you don't have enough assets behind you to back it up. Again, think of a corporation as like a separate person almost, separate legal entity who's running a business. We're going to look at this other disadvantage. Management may make decisions that are not good for the corporation. So here are some underlying foundations about how corporations work. Their stockholders. Stockholders elect board of directors, and board of directors hire management people. Usually, not always, but I think the board of directors generally can be said to say that they hire one person. They hire the CEO, and that CEO runs the company. And besides deciding major business policies, the corporation's board of directors might authorize new contracts, maybe above a certain amount. They set executive salaries. They do a lot of the authorization for loans, and they declare or not declare dividends. Management of a company consists of its operating officers. It carries out corporate policies. It runs the day-to-day operations and reports the finances back to the board and back to the stockholders. Let's talk about equity financing. This is how corporations usually get their money. It's done by issuing stock in exchange for assets like money. So once stock has been issued, stockholders can transfer their ownership at will. So owning stock is a great way to have some investment in the company, get some dividends paid back to you. And for the company, it's a way to raise capital. Let's see. Yep. So some of the advantages and disadvantages of equity financing. One of the advantages is it decreases financial risk. You issue common stock. It's less risky than actually borrowing money. So if you need to raise money for your company, for a corporation, you issue common stock, you get money back. You have immediate cash in hand to go out, and you don't have to borrow it from a bank. The unfortunate advantage is that's also dividends paid out are a tax liability. And you have what's called decreased stockholder control. So when a corporation issues more stock, it dilutes its own ownership. The more stock a company issues, the more owners there are, if you will. And so everyone's share of the ownership gets a little bit smaller the more stock that's issued. Some of the components of stockholders' equity that we've been talking about, there's contributed capital, retained earnings, and treasury stock. Make sure you read about those in the book. The treasury stock, in short, is just, it's a little bit kind of a tricky term, but it's the corporation buys some of its own stock back or owns its own stock. It's called treasury stock. It's not stock owned by outsiders from the company. So the company actually holds some of its own stock. It's called treasury stock. Now, there's two different kinds of stock that is issued. There's common stock and preferred stock. Common stock is the most commonly thing that you would look at and probably would be able to purchase on the open market. Preferred stock gives owners preferences in some decision making in the company. When there's of all the authorized shares that are out there for a particular company, that's three different groups. There's unissued shares, maybe shares that are kind of held back. There's outstanding shares. Those are shares that the company has issued and they're in circulation. They're in the stock market, for example. And then there's these treasury shares, which again are the company owns its own shares. Make sure you look in the book about how to account for the cash dividend. Excuse me. There's some pretty good examples in the book, some fairly simple examples about what happens when with cash it gets paid out in dividends. And there's some reasons that a company might not pay out cash dividends, and some of those are listed here. Some important dates about dividends. There's the declaration date, the record date, the payment date. The record date is the date on which the ownership of stock is looked at. It's like the rolls looked at, like, okay, who's on our list today and who's going to get paid out. I gave you a good example of Apple's dividend history that shows a number of these dates and a number of how much money they paid out in their dividends. It's in the extra materials for success in the module. Stock dividends proportional. So instead of paying out stock, instead of paying out cash, sometimes companies will either split their stock or they'll issue more stock based on how much you already own. So like a stock dividend instead of a payment dividend. And there's the note about stock splits. This last item is the price per earnings ratio, also called a price multiple. Pretty important concept. It's used a lot. If you watch it all CNBC for an hour or two, you'll hear these, you hear the word multiple price earning ratios and that sort of thing. Get to know those concepts in the book. In short, a PE ratio, a high PE ratio could indicate a company is maybe even overvalued. But generally speaking, a high PE ratio or a high multiple indicates that the company has a lot of potential as well. And so people tend to look at companies with high PE ratios. Low PE ratios, though, could mean a company is undervalued, meaning like it would be a great buy right now on the hope that it will get better. So anyways, also there's a link in the module, Canvas module as well, showing some information about PE ratios that I found. Okay. Listen, that's it. You guys have a great week, and make sure you contact me with questions.